In this video, I'm going to take a look at cash flow. Cash flow is rather important both for me as an individual and if I were to run a company for any company. It's very important to know what cash comes in and what goes out and the timings of those cash flows. The important point is that neither I as an individual nor a company as a trading entity must run out of cash. That's not good. Technically, that's bankruptcy. So if we think about a cash flow, we produce a document that summarizes the cash in and cash out. If we do that either retrospectively or up to current time, the document is called a cash flow statement. If we do it looking into the future, then it's called a cash flow forecast or a cash flow prediction. And the important point about a cash flow forecast is that it's a model of the future. It hasn't actually happened yet. So we have an opportunity to look at the timings of our cash coming in and the timings of cash going out, and just checking to see whether our closing balance moving into the future at no point goes negative, because obviously that's not good. Okay, we're going to explore this by taking a look at a case study. I'll then produce a basic cash flow model using Excel spreadsheet. We'll then populate the model with information from the case study, and finally we'll analyze and look to see what we've got by way of problems. So we'll then try and analyze those problems. These 4 steps are quite a good way of getting into a case study or a cash flow forecast. So the case. I'll read this through first of all, and then we'll flip over and produce the template, and then we'll come back and take a look at it again. So Ian and Sue Workhard are a married couple who both work for the Acme Toy Company. Ian works in the new product development department and Sue works in marketing. They live in a house in the neighbouring town and have a mortgage which is currently costing them £420 a month. They've also got a bank loan. If you're following this through with me, which I hope you are, they've got a short-term goal of an exotic holiday in the Far East. Good for them. Enjoy the sunshine, which they've planned to take next year. They've got to pay the £1,500 deposit for this holiday in May and the balance of £3,500 in October. So both Ian and Sue are paid monthly into a joint bank account, and their total income is £1,650 per month. They've got hobbies, and one of them is cars. So in addition to the Ford Mondeo car that they use as a runaround, they also have an antique Rolls-Royce, which they bought 20 years ago. They've got no children, so they can afford to spend money on their hobbies, especially driving the car around, their Rolls, of course. Both will receive a pay rise of 8% starting in their October pay packet. Okay. In addition to that basic information, in a typical month they spend £325 on food, as it says here, £135 on petrol. They've got rates to pay. They've got a clothing allowance of £75 per month, and they have bills which are paid quarterly. They've also got an annual payment of £500 for insurances, which is paid in January, and £220 for road tax for the vehicles, both paid in April. Now, you can see from this case study that the amounts are specified and also the timing of those is clearly stated. And we must make the assumption that this is their entire cash in and cash out, because we're not told anything otherwise. The other piece of information we've got here is they're not particularly good at saving money. They've started the year with no cash in the bank and have no other savings. So in that respect, okay, a bit naughty, but okay. Right, so our first task is to produce a cash flow forecast for the coming year. And then the second part is to help them solve any financial problems they have with the constraint of not sacrificing their overall quality of life. And I'll come back to that a little later on. Okay, so first of all, let's flip over now to an Excel spreadsheet and create ourselves a basic cash flow model. And if we had to produce yearly cash flow forecasts for a number of things, we might want to save save the outline for this model in a template and use it later on. But I'm not going to do that. We're just going to create the template. So I've got a blank spreadsheet here, and I'm going to start off by putting the months in, going across as columns, leaving the first one blank for the description of the item I'm going to put in. And it starts in January, and then we've got February. And I could type every one of these in across to December, but actually Excel's quite intelligent. It knows that if I've typed in a month and I want to increase the number of months, I can do just by dragging and dropping the bottom little handle down in the corner here, that. Okay. Now, how you lay out a cash flow forecast is entirely up to you, but the convention is that you'd have cash inputs at the top, followed by cash expenses, and then the summary towards the bottom. So I'm going to follow that convention, and I'm going to have cash in. Now, remembering the case, there is only one cash in. It's actually salaries. So I'm going to put one line for salaries. I'm going to leave a blank line. Then I'm going to put cash out. And I can't remember what those all are, so I'm going to come back to those a little later on. Now, a little bit further down here, we're going to have a total line for total cash out. We've already got total cash in because it's salaries, there is only one. And then below the cash out total, I'm going to put the opening and closing balance lines, but we'll come back to that in a little while. So if we go back to the basic template, we'll now go through the case study and identify all the relevant information. We'll transfer that information over to the spreadsheet, and it's a good idea, so you don't lose track of where you are, to cross off or highlight the information as you transfer it. That way you don't miss any information and you don't transfer anything twice. And in all of the cash flows that I've ever marked as assignments, that's the biggest problem. Information gets missed or information is counted twice, but not very often. The other problem is it goes in the wrong box. So it's attention to detail that's important in this exercise. So let's remind ourselves of the case study. And the first piece of information I want to extract here is their monthly salary. So that's down here at £1,650 per month. And I'm going to highlight everything in red, or change the text in red to indicate that I've picked that information up. So £1,650 per month in salaries. Go back to the spreadsheet. Salaries, £650 per month. And again, I can copy that figure. This time it's only a figure, so Excel doesn't do anything with it. It transfers it across. Okay. Now, the other piece of information we've got about their income is that they have a pay rise. And that pay rise is 8% per year. It's 8% per month starting in August. So we need to put that into our cash in model. So back to the spreadsheet. In August, it's 1,650, but now I want to increase that. So I'm going to change the way I've done this for reasons which will become clear in a minute. But if what I want to say is February equals the amount in January, and copy that cell across. Right, now every month is the previous month's salary. But in August they get an 8% pay rise. So the August salary is the July salary multiplied by 1 plus 8%. Oh, no. What's that done? 1 plus 8%. I've hit the wrong button there. Okay. So it's increasing it by 8%. In other words, up to 1,782. And because September equals August's figure, it's automatically updated the model for all subsequent months. So that little trick of knowing how Excel will work with numbers means you can save yourself a little bit of trouble with numbers. But you've got to be very careful here. Okay, that is the only cash in. Let's start taking a look at cash out now. So let's go back to the case. And we have, as the next item, we've got the mortgage payments, which are £420 per month. So first line of cash output, mortgage, and this is £420 per month, and it doesn't change, so I can just copy that across there. Back to the case, and the next one is a bank loan of £150 per month. Okay, so we pick up £150 per month. Oh dear, I'm typing problems here. Bank loan, £150 per month. Copy that across. The next we have is their exotic holiday. So here we've got a £1,500 deposit paid in May and the balance of £3,500 in October. So first thing is, let's highlight those so that I know I've picked them up. And then we've got deposit and final payment. So holiday deposit and holiday final payment. And the deposit, you can see, is due in May. So we've got 1,500 in May, and the final payment is 3,500 in October. Okay, so we've got those in the right months. Let's go back to our case, and just a quick scan down here that we've picked up all of the relevant information. Got a little bit of irrelevant information here for this particular case. The Rolls-Royce is 20 years old. Not a lot of useful information in that for the cash flow forecast. So let's go to the second part. Typical month they spend £325 on food. So let's pick up that food figure here and transfer that across. 325, and copy that all the way across. The next one is petrol at £135 per month. Ooh, what's that called? Petrol. £325 a month. And we might as well do rates as well at the same time at £25 per month. So petrol. £135 and rates 25. And I can copy both of those across by highlighting that cell, moving them across. Okay, so that's picked up petrol and rates. And the next one we've got is a £75 clothing allowance per month. So let's just highlight that one and pop clothes across into the next row. 75. Copy that across. Okay. Next, we've got utility bills, average out at £150 per quarter for gas and electricity each. Okay, so there's two of them, £150 per quarter each, and they're paid in March, etc. So what does that mean? Well, we've got gas and we've got electricity. And in March, they pay £150 per quarter for each one. £150 for gas, £150 for electricity. And again, in June, that's the next quarter. In September, again, check everything as you do each entry in. Make sure that there are no mistakes. Okay. So that's gas and electricity sorted out. And I should have highlighted those, so they're now highlighted. The next one is £120 per quarter for phone bill. Again, that's paid in March, etc. So we'll just colour those in and pop those across. So phone bill, let's give it a capital letter, phone bill, and these are payable in, again, March. So it's the same period. Let's call water again, 120, 120. Okay, that picked up phone bill. Then we have an annual payment of 500 for insurances that are paid in January, and 220 for road tax. So that's, oops, identified that one as well. So okay, let's do the insurances for 500 in January and the road tax 220 in April. Insurances 500 in January, road tax 220 in April. Okay, and again, a quick check to make sure that we've picked everything up. We have, but I've actually also highlighted here a little bit in advance that the opening balance is 0. They're not very good at their cash management, so they start the year with 0 money. None in the bank, none in savings. So that's our opening balance. Let's go back to the spreadsheet then, and just down here I'm going to put opening balance. And in January the opening balance is 0, so I've now got that piece of information. Okay, now you can see the that line item has gone across the break here, so I want to extend that column out a little bit. I could have double clicked on that, that would have automatically made it equal to the biggest. And we can still see December, so that's good. Okay, so I need a total line for the cash out, so I'm going to give a nice descriptive total cash out, and that equals the sum of all of these cells. That sums everything in that line, and I copy the sum all across. So what Excel does now is just computes the sum of these cells, pops it in there, these cells and pops it in there, etc. Okay, so I can now start to produce the bottom 4 summary lines, and the first line here is cash in, then we have cash out, and what I could do here is put a net cash flow. This is typically what companies do. So that line will tell them how much the balance of cash in to cash out is in every month. So I'll put that in as well, and then we've got closing balance. So the opening balance at the beginning of January is 0, comes from the case study. Cash in equals our salaries. There's no other, so that goes in there. And our cash out is the total cash out, which is that figure there. And our net cash flow equals cash in minus cash out. And in this particular month, it shows it's a positive £20. So they're better off. And the closing balance equals the opening balance. Now what I could do here is plus the net cash flow, or I could say it is plus cash in minus cash out. Both will give us the same answer. So I'm just going to do it as plus the net cash flow. Now if the cash out is greater than the cash in any month, the net cash flow will be negative, and the sign of the maths here will sort itself out. So it remains good calculation. Now the opening balance in February is the same as the closing balance in January. And just to finish this all off, I can copy those cells across, then pick up those cells, copy all of those across. So now I have in that line there the closing balance in every period. Just bear with me for a second. Air conditioning unit came on, so it increased the noise a little bit, so let's switch that one off. Okay, so that's what our closing balance looks like. Great, good, we've finished the cash flow forecast. Okay, now we can analyse it and solve any problems. So as far as a cash flow forecast is concerned, what constitutes a problem? Well, a negative end of month closing balance is a problem, because what it means is that they don't have enough money in that month to pay the bills that are due. So technically they are bankrupt. They can't pay their bills when they fall due. But that's a bit of an extreme term. There are 2 months in which that occurs. We can see that is occurring in May and also in October. Okay? And it's a fairly big one in October. It also remains in November and December. So let's take a look at the May one to start with. What can we do? Well, remember, it's a forecast, so it hasn't happened yet. You don't want it to happen, really, because you're going bankrupt, and that's not good planning. If you plan to go bankrupt, well, you deserve everything you get. Okay. So, what can be done? Let's take a little look at the case study again. Task 2 is to help them solve their financial problems without sacrificing their overall quality of life. That's a key point. The overall quality of life shouldn't be sacrificed. So let's take a little look at the model again. Focusing on May. What could we do? Well, we could actually not pay bills. We could take the gas bill due in March and we can say, not going to pay that, but I'll be kind and I'll pay. Well, actually that would solve the problem, but your gas would be cut off. So overall that's affecting your quality of life. I could say, oh, well, I'll pay it a month late, £150. Okay, so we put that back in, but actually it doesn't solve the problem down here. The timings are wrong. Okay, so let's put that back. What we need is to change something that affects May. We could actually not pay rates. We could not pay the rates and pay double the amount that month. But actually that makes a difference, but it doesn't solve the problem enough. So let's put those two back. What about clothes? Actually, if we take the clothes out, we say we're going to pay nothing on clothes in May, but we're going to buy double the amount in June. That solves the problem. So our negative down here has gone. So we can survive, or they can survive. Okay? And arguably, because they've spent $150 on clothes in both May and June, overall their quality of life has not changed. It's not been affected. So arguably that proposal solves their problem and it meets their constraint. Okay? So that's an example of how moving cash transactions around can change your bottom line, your closing balance, in a very beneficial way. Let's take a look at the other one, the minus 1,384. That's a bit more of a serious problem because that negative can't really be corrected, and it can't really be corrected by moving anything. It's too big. And because it persists all the way through to the end of the year, what it's saying is that actually they've overcommitted on their holiday. They're going on a holiday they can't afford. And if this is a complete prediction, then they should be saying to themselves before they start this year, actually we need to scale back on the holiday a little bit. It's £2,000 a holiday this year, and save some money aside, like £1,500 this year, so that they can have this exotic holiday next year, assuming everything else remains the same. So that's cash flow forecasting. So what we've done in this video is we've taken a look at the cash flow. We've used a case study to create a basic cash flow model. We've then populated that model with information from the case study, making sure that we don't miss anything and we don't double count anything. We've then analysed the overall situation and looked to explore and resolve any outstanding issues. So that's about it. Thank you very much. I hope you've gained something from watching this video, and there'll be more to come.